In this video, we will take an introductory look at the balance sheet. Reporting regulations instituted by regulatory bodies and authorities require that firms produce and report certain financial information. Such reporting helps various users of financial information in their decision making. The required financial reporting includes the following financial statements: income statement, balance sheet, cash flow statement, and statement of changes in equity. The balance sheet shows the firm's financial position on a specific date. It provides a snapshot of the firm's financial position. The balance sheet will list the firm's assets, liabilities, and equity. The balance sheet is more commonly called the statement of financial position. The balance sheet totals are defined by the following equation: total assets equal total liabilities plus total shareholder equity. It's important to remember that the balance sheet shows the firm's assets, liabilities, and equity. In other words, the balance sheet shows what assets are owned by the firm and how they are financed. Remember, total assets is equal to the total liabilities plus total shareholder equity. This diagram should simplify that. On one hand, you have what the firm owns, and that is the assets. On the other hand, how does the firm pay for it? It does so by the use of liabilities and the use of equity. So we have assets being equal to liabilities plus equity. This is a simplified example of a balance sheet. On one side, we have the assets consisting of buildings, 75,000, equipment, 25,000. Together, they total $100,000. On the other side, we have the liabilities, a loan, $15,000. We also have equity, or $85,000. Together, they sum $100,000. This demonstrates the accounting equation for the balance sheet. The assets equal the total of the liabilities and the equity. So, as we focus even more narrowly on this equation, you can see the assets of the firm being $100,000 would have been financed by the liabilities of $15,000 and the equity capital of $85,000. So let's take a detailed look at what these assets, liabilities, and equity represent. Assets are those resources that are owned and controlled by the firm. Assets are used by the firm to generate income. On the other hand, liabilities are amounts that are owed by the firm and they are to be paid or settled. Equity represents the shareholder's stake or investment in the firm. Now, let's take a closer look at the assets. Assets, as you recall, are a firm's resources. They can be classified as current assets or as fixed assets. Current assets include cash and other assets that the firm expects to convert to cash within a period of 12 months or less. These include accounts receivables or debtors, inventories, bank accounts, and money market accounts. Fixed assets, on the other hand, are more permanent assets that are owned by the firm. These assets are generally used in the business for many years. They include land and buildings, machinery, equipment, motor vehicles, office equipment, fixtures. These are all permanent or fixed assets. Let's look at liabilities. Liabilities then are debt obligations of a firm, and liabilities may also be classified as being current liabilities or long-term liabilities. Current liabilities are amounts that are due and are to be paid within a period of 12 months or less. Examples of current liabilities include your accounts payable or creditors, accrued expenses, which are amounts incurred but not yet paid, or short-term notes. Long-term liabilities are amounts that are due to be paid or settled beyond a year's time. Examples of that include mortgages, bonds, and other long-term loans. The equity of the firm, which is also called the common stock or the stockholders' equity, is the investment stake of the owners in the business. It represents the money invested as well as any profits retained and other reserves of the business. So when we speak of equity, it constitutes the capital invested, any retained profits, and reserves, including foreign exchange reserves and revaluation reserves. The balance sheet may be presented in two formats, a horizontal format or a vertical format. Using the horizontal format, the assets, both fixed and current, are listed on the left side of the balance sheet. The liabilities, again, both current and long-term, are going to be listed along with the equity on the right. In the vertical format, the assets, again, both fixed and current, are going to be listed at the top of the balance sheet. The liabilities, current and long-term, as well as the equity, are going to be listed below the assets and complete the other half of the statement. Take this look at what is a horizontal format of a balance sheet. Notice the assets that are listed on the left, fixed assets as well as current assets, and the total 75,000 is shown at the bottom. But then we have on the right side the current liabilities, long-term liabilities, and equity, and again they sum 75,000. So it still holds that the accounting equation is maintained. Total assets is equal to total liabilities and equity. And here's our final note. The balance sheet, or the statement of financial position, is one of those financial reports that firms produce to provide information on the firm's financial position at a particular period of time. The balance sheet lists the firm's asset holdings as well as its liabilities and equity, and it gives an indication of the firm's financial health. This covers our introductory look at the balance sheet. Be sure to check out our other videos as we explore the concepts relating to finance and business.